overdone for this year, but what about 2023? And what about when that balance sheet reduction starts happening in earnest?
Morning. Well, it really depends on the path of inflation. I think balance sheet reduction, of course, is one factor, but on its own, again, until it combined with policy that's really tight, is something I'd be a little bit less concerned about based on past experience. I think the key here really is that a lot of pain we've seen this year seems to ultimately sort of root back to the repricing higher of Fed expectations, which clearly went on longer than a lot of the market expected. But if we're really at that point now where the Fed is only delivering on what's priced in, which in turn is determinant of inflation not surprising further, if anything, peaking around where we are today, we think that, of course, might start to cool some concerns about, this continued repricing higher Fed rates and, of course, the impact on growth. And I think that's what gives us a little bit of room for optimism given where we are today, at least looking out over the rest of this year.
What is going on when it comes to positioning on bond markets at the moment, sovereign bond markets and treasuries?
Well, I think the few factors going on there. I think one is the backdrop is that positioning was quite one-sided. We saw that across the host of indicators, including our own proprietary measures. And I think that, of course, really exacerbated, some of the moves we saw. But, it does sort of feed into a bit of a shift in theme we've seen over the past few weeks, which was, earlier worries about inflation, how much the Fed would reprice. But we have got a few rumblings about worries about economic growth. And I think these are obviously led by individual data points at the moment. It was individual retailer earnings, housing market data yesterday. And I think that's sort of what's driving that. But I think 2 points I'd make there. One is for asset allocators, for multi-asset investors like ourselves. It's almost a good thing. We're finally moving away from everything being correlated to that Fed move in one direction, up or down. So arguably that's good for diversification. It's something we've missed for a large part of this year. And second, for economic growth, look, if I use a major benchmark like the ISM or PMI data points, yes, we know it's slowing. We expect that at the start of the year. But at the end of the day, for investors, for financial markets, what matters is whether we go all the way down to recession or near recession levels. And so far, we don't look like we're going there, at least on a lot of those mainstream benchmarks. So something to monitor, but not something we're excessively worried about at this point in time, at least.
Manpreet, on the diversification case, what are you seeing in terms of the diversity on global government bonds at the moment? And are there any opportunities to average into some of these markets?
Well, on the bond side, I think, look, they were elevated. I wouldn't be surprised if after yesterday's move, we see that ease up a little bit, in terms of investor diversity. It's one of the measures we look at, of course, in terms of look at where the positioning is too one-sided. But I think the opportunity here is that if yields are really not climbing higher, and it links back to the point about if the Fed is not repricing rate expectations ever higher, then, of course, we may see some opportunities to rebalance back towards bonds. Now, that doesn't mean one should ignore equities. We still think there are opportunities there from a sector perspective in the U.S. or, of course, in China, where we think valuations are bombed out. But in bonds, what we'd rather do, rather than jumping into treasuries alone, we'd look for asset classes which are sensitive to a topping out of bond yields, but also have other factors supporting the risk reward. So EM dollar bonds, for example, is one asset class that has been quite sensitive to the rise in bond yields. You do get a lot of duration there, but credit spreads are also very wide. So I think you're not relying on one engine of returns alone. So I think that's one good example. In addition, of course, the high yield, and we still think Asia dollar bonds is still a relatively uncorrelated area within that, because it's much more about getting to a turning point in Chinese policy rather than sort of a US dollar duration call. So I think that's a mix of assets which we think starting to look interesting again.
Are you seeing that turnaround in Chinese policy? We have seen dozens of new measures coming from policymakers. I do wonder if there is a good time to get into Chinese property right now.
Well, timing a specific bottom is always tricky. And I think the one thing with policy measures is that one does need patience. It's a lot of measures, have a hard time having a direct impact when an economy is in lockdown. So I think one point we'd make is that we do need to get past the most acute phase of lockdowns of large parts of the economy. And second is many measures like credit. We have seen the credit impulse turn higher. We saw, obviously, PBOC encouraging lending. But these are measures that start having an impact on markets and the real economy with a lag of a few months. Now, the good news is we've already seen several of these measures start to turn higher, at least from a credit impulse perspective. So at the end of the day, for 6 to 12-month investors like ourselves, we do believe those conditions are in place, whether that's for equity markets, where valuations are extremely low, whether relative to their own history or, at a 30% discount to global equities, or in bond markets where, we don't need to repeat how bummed out valuations are in the high-yield dollar space. So at the end of the day, we think what's a positive catalyst, the direction is clearly turning. There's clearly much more effort. There's a raft of measures to support economic growth, and I think that's the catalyst we're looking for. I think there are a few specific measures in high yield, for example, to support liquidity. I think that will really be the key if that extends to unlock some of the value there. So I think it does require patience. It's tough to time a bottom, but for long-term investors, we think the value is definitely there.